So what I was going to ask you, Alex, is so your firm,
Mm-hmm.
you guys are a full service CPA firm,
That's right.
right?
Yeah.
And a lot of people, when they think of CPAs, it's their CPA, typically one person, two-person shop, maybe,
Right.
and they go there for compliance work or
Once a year, usually. Yeah.
yeah. And when we say compliance, we're talking about tax returns,
Right.
right? And maybe they'll
Exactly.
do some accounting work, maybe some bookkeeping, maybe some payroll.
Mm-hmm.
Oftentimes they'll outsource it via the accountant. But
Right.
what is a full size or
Full service
full
firm.
service
Yeah.
CPA firm? Yeah.
So yeah, full service CPA firm is one that uh, our office is about 100 people, so it's pretty good size. We've got people in every industry. We do a bunch of different stuff, but a full size is we offer bookkeeping services, outsource CFO work. That's anything from daily transactions all the way to monthly closeout, all that sort of stuff. And then we do tax returns, we do tax planning, we do all that important stuff to minimize taxes. And then we also offer audited, reviewed, compiled financial statements, usually, the banks like that, bonding agents for construction industry, that sort of stuff. That's what they really want. But yeah, we want to be involved all the time. We want to be a point of contact for the client.
Yeah, so it's a little bit different than just hiring somebody to carry out a task. You're
Right.
doing more of an advisory work, and I've noticed this too. If you look at the landscape, for the most part, the solo practitioner CPAs, they're focused on compliance work,
Right.
which is tax returns, and I get it, right? It's the business models that way,
Right.
and so for a business owner, sometimes it's really difficult to find the CPA firm or the CPA that does advisory work.
That's right.
And so when you guys are doing advisory work, talk to me a little bit about what that means.
So advisory work can be on any of the three areas I talked about, but I'm a tax guy, so I'll talk about that. One of the things I really like is when my clients are talking to me throughout the year, we're talking about if they're looking to buy a huge piece of equipment, what that's going to do for their taxes. We're talking about hopefully a couple of years out, we're talking about exit strategy, because that should be a multiple year conversation that we should be having with attorneys and other agents and getting that whole thing together. But yeah, we're looking at an advisory role in that we're going to support them. We're going to look at all that they have. We're going to be looking at the balance sheet. We're going to be taking a look at all of their information systems that they have. And we're going to be offering long-term planning in addition to minimizing taxes, but finding the right balance between those. Because you can minimize your taxes all you want, and then when you're looking to sell, that might not be the best place. So that's what we're trying to strike, that nice balance in between. And that's whatever our clients need is what we're gonna provide. And if we can't provide that, we're gonna bring in somebody else that can.
Well, I'm glad you brought that up, talking about, the balance between taking the maximum deductions now, but also making it attractive for a buyer later. We see this all the time, right?
Mm-hmm.
We're looking at somebody's financials and we're like, why did you do this?
Right.
Well, we wanted the biggest tax breaks this year.
Right.
So talk to me a little bit about exit planning. You talked about it being multi-year plan. You talked about the different folks that might be on the team. You obviously got the CPA, you got the attorneys, you probably have an M&A advisor,
Right.
And other folks involved. When somebody is looking to exit and they're talking to you and they're saying, hey, I'm thinking about exiting in the future, so balance out my compliance work with how should I get this ready? What's the process look like?
Yeah. The process starts with having that conversation and the client recognizing that they're not going to be there forever, right? They are going to have to exit at some point. And then they have to start having the conversation of, if they have children, is that someone they want to bring on? And that's something outside advisors can facilitate. I feel like we can make that a little less daunting to start that conversation. Or if it's an outside sale, and then we can talk about different groups that are looking to purchase, like we had talked about private equity, could be just another larger company looking to come into the area, that sort of stuff. But where we come in as a CPA firm is we're going to be looking at their financials. Hopefully at that point, we'll have been doing their financial work and also their tax work. So we have the whole picture. And what we're going to be doing is we're going to be taking a look at the company's financials, and we're going to be identifying risky areas, and we're going to be interfacing with an attorney like Jack. We're going to be talking about, is this an area that the purchaser is going to be really hammering us on? So we need to get this taken care of multiple years, hopefully in advance, and get this all straightened out. We're going to be, we're going to be, like we talked about, looking at finding the middle ground of the maximizing the tax deductions versus maybe investing in some equipment that is going to look good in the future that you may take a hit on in the short term. And we're going to be making those sorts of decisions, and we're going to be having that conversation with the client. We're going to be bringing in a wealth advisor, and we're going to be talking about what is best for them personally, in addition to maximizing the price they're going to get for the sale, hopefully.
Yeah. So there's a lot to unpack there, and I just want to go through them a little deeper. So you talked about the way they structure their finances is going to impact the purchase price down the line. Mm-hmm. And, working with a firm like yours that understands valuations, mm-hmm. understands how it impacts is huge, right? Because at the end of the day, what does a business owner care about when they sell the business, besides obviously their legacy, is mm-hmm. bottom line, how much money is going to end up in my pocket?
Right.
And the amount of money that ends up in your pocket is based on how much you sell it for, but more so how much you keep.
Yes.
Right. So proper structuring is so important. So talk to me a little bit more about when you're advising business owners on a future exit mm-hmm. and bringing in the valuations. What are some of the variables that go into maximizing the value of the business that ultimately they're going to end up with, right? So for example, we know having clean books is going to give more certainty and so forth. Mm-hmm. But what are the different variables that from your perspective, that maximize the valuation that a business owner is going to get for their business?
Yeah. Well, I think part of it is stuff that the CPA isn't necessarily going to control, but we can have part of the conversation. Having a good management team is really important. That's something that an outside investor is going to be looking at, and it's kind of an intangible, but that's important, I think, for the valuation. Also, kind of looking at your mix of what you've got on your financials. There's different items on the company's financials are going to be taxed at different rates. I'm a tax guy, so this is where I go. Mm-hmm. But it's important to look at that and think about that as you're starting to set expectations for what you're expecting for the sale and the valuation of the company. We're also looking at, kind of the current market. We don't provide valuations, but we have good relationships with folks that do. And we're having an ongoing conversation with them throughout the whole process, making sure everybody's aware of what's going on, that sort of stuff.
Yeah, you mentioned liabilities. Mm-hmm. So what are those liabilities that you're concerned about that you'd want the attorneys to look at as you're setting up their structure?
Yeah. So there's liabilities in an accounting perspective of what you actually have on your books. So that's accounts payable, that sort of stuff. Not to get too deep in the weeds, but that's the stuff you know about. And I think a really important thing that we don't always think about is a search for unrecorded liabilities is what it's called. And that's issues that the attorneys can really help with and do an analysis for. They're talking to the client and they're talking about, okay, if they sell bolts, what's the chances one of their buyers is going to bring a lawsuit if a bolt breaks in a really important piece of machinery, and kind of looking at the risk of lawsuits and liabilities there as well.
Yeah.
Yeah. I mean, in a lot of sales of businesses, we deal with representations and warranties, and there's always a representation about what your financials look like, usually for multiple years. Generally, you'll see like 3 years. Sometimes a buyer will ask for more. And then you'll also have a representation about if there's anything that's not on the balance sheet or the financials that could be a liability, and having the ability to work with a competent CPA who knows what they're doing, all of a sudden we have a lot of confidence in the representation we're making or we can make disclosures about it to make that representation true, and less likely to become an issue after closing.
Yeah, you mentioned you're a tax guy. I'm a tax guy, so we have something in common here that we like to talk about. And in regards to valuation, so as you recall, back when the Tax Cuts and Jobs Act took place, there was a lot of deliberation amongst tax advisors to work with their business owner clients to say, hey, should we keep the S election? Should we convert to a C Corp? And from a valuation perspective that banks were using to give out loans, what they would do is they would take the S election company for purposes of doing the analysis, convert it to a C Corp tax rate, and then the valuations went through the roof. Right. And we saw a lot of money coming in, a lot of valuations go up. And now we're going to have this sunset of the Tax Cuts and Jobs Act in 2025. Individual provisions go back, corporate stays the way it is. Although with this new bill that passed, it's not going to impact lower middle market companies as much or at all. But what's your take on right now when we're looking at the sunset coming up in the next couple of years? S election versus conversion to the C Corp. Right. What are you seeing out there?
Honestly, in our practice, we only had a couple that when we really dug down into the analysis, they were even interested in doing a conversion to a C corporation. We do a lot of privately owned middle market businesses, and the owners liked the structure, whether it was they knew how it worked or it just didn't make sense financially. They decided to stay with their S corporation structure. And yeah, with the sunsetting of the provisions, we could see some conversions back. It's very possible. There were a lot of large publicly traded companies that had made a transition from partnerships to C corporations. I know some oil and gas partnerships did that, and it made sense for them at the time. That was big dollars. But as far as middle market that we saw, it didn't affect a lot. Honestly, when it came down to it, the owners were more comfortable staying with what they knew. And with the qualified business income deduction, 20% off of your qualified business income. But that deduction was enough for them to feel comfortable staying where they were.
Yeah. So interesting point on that. If you recall, beginning of this current administration, they were talking about getting rid of QBI deductions.
Right.
It didn't make it into this last round, but we think that that's still on the table if the makeup of Congress stays the way it is.
Right.
And so if you look at the increased enforcement that's coming, by that we mean, they're about to hire a bunch of IRS agents, and
thousands
the number of
agents,
thousands of agents, and the number of audits are going to spike. And if you look at where they're going to go, they're going after privately held businesses. So whether it's Schedule C filers, pass-through entities, and individuals, but for our purposes, we're focused on the business owners. Having clean books becomes even more important. Right. And so the last thing somebody wants to end up with is an audit, not because of the fear of the audit, but just to drain the resources, the time. And at some point, business owner is going to say, you know what, just pay it, make this go away. And it's unnecessary if you do proper record keeping. So, and I know you guys in your practice, besides the advisory, like you talked about, you guys also do outsourced CFO work. So typically, what is the size of the business that is going to require an outside firm like yours to come in with your expertise? What does that look like?
That can be what we've seen a lot of is there's a lot of companies that have CFOs that are getting older. They're baby boomers and they're getting ready to retire. And the owners are looking at the cost of hiring a new person, training them up, paying all their benefits. And they're realizing that paying us to do all of their accounting work that then we can bring straight into a tax return or a financial statement makes more sense for them at the bottom line than it does to have a multi-year investment in somebody new that, with the job market like it is, may or may not stay there after they've been trained. And so we have clients of all different sizes. We have everything from a mom and pop store at the corner that does, maybe $1 million a year, that just wants us to handle all of the books for them. that they just don't want to deal with it, all the way up to we have clients with hundreds of millions of dollars that want us to come in on a weekly basis. They have people that are competent on a daily basis, but they want us to come in at the end of the week, make sure the weekly reconciliations are correct and all of that. So it's really a great space for us to be in because we can offer that service, and it really is it's like a comfort blanket for them, right? It lets them know someone's looking at the books, someone's making sure that their people are doing it right if they do have in-house people. And it's letting them know that the financial statements that they're generating, providing to the bank or whoever they need to send them to, they're in good shape. There shouldn't be any real issues if you've got a competent CPA firm coming in looking at those. Of course, we can't guarantee there's not issues because the owner is ultimately responsible for the financial statements. But if you have someone competent looking at them, they're going to ask questions if there's an issue that they can foresee. And so I think that's really where we add value, is that we can let the owners feel a sense of comfort with what's being generated through that system.
Earlier we were talking about conversions, and this comes up a lot in the M&A context where a buyer isn't always happy with the tax election that the seller has made. And the buyer comes in and says, look, we're going to have to change your tax status, and there's going to be tax consequences, and there's a negotiation around who's going to pay for the consequences of that change. But when someone comes in, let's say a new client, they're an S corp. S corps were in vogue for a long time because of certain tax advantages.
Right.
And now their business has grown, their business has changed. When you form a company, you have to make a decision. Usually, you have to make a decision whether you're going to elect to be an S corp or not.
Right.
So what have you found, let's say over the last 5 years, is driving a change in tax status from S corps?
I think you hit the nail on the head when you said it's acquisitions. Honestly, that's really where we see a lot of it. When we have new people come in to the firm, we have that discussion with them. I have a couple of clients that are actually business partners, and they each have their own firm, but they work together, and they're real estate brokers. And they came in, we looked at their situation, looked at their last year's return, and we said, it could really benefit you to have an S corporation. And so we went through, and every year end, I'll sit down with them and we'll do some tax planning to provide them a reasonable wage, because that's an important part of having an S corporation, is paying yourself a normal, reasonable amount according to the IRS. But then the distributions you take out of there are tax-free as long as you pay yourself a reasonable wage. And so that's the discussion we have with them, and we do a wage. And in addition to that, we also maximize their QBI deduction. So we make sure that they're getting maximum savings, they're getting maximum non-taxable funds out of their S corporations. And we're also looking at their books throughout the year, making sure that everything's okay. But yeah, as far as driving of S corporations, like I mentioned, we haven't had a lot looking to convert away. As current situation, we've had several that have elected S corporation, but we have had several new clients come in that have had busted S elections,
right?
Which is a huge issue liability wise, as you know. And so we've had to back those up, and then we have to go through the whole process again and deal with that. So when you elect an S election, it's extremely important to do due diligence beforehand. It's not something you just decide to do. This is a process that needs to go through the works, I feel like.
Yeah, so talking about due diligence and M&A transactions, perfect segue here. We talked about having clean books for the purposes of compliance work and potential audits. But part of having clean books is it gives more confidence to the buyer, which drives up the valuation. So when a private equity, for example, comes in, one of the things they're going to do after they look at you have clean books, they're going to do their own due diligence, right? And so that process, you could really save a lot of money if you've done the prep work ahead of time. Talk to me a little bit about the due diligence side that you guys provide.
Yeah. So we are, like I said before, we're going to be looking at them on an ongoing basis. But in an M&A transaction, we're going to be, as far as in my experience, I've mostly been on the seller side. So we are interfacing with the other side's due diligence, and we're taking care of any questions or explanations that they need. Hopefully, our client has been a client for a while, so we're actually familiar with their situation and they're not brand new. But even if they are, we're going to interface directly so the client doesn't have to field all those questions and play middleman. That's not their job. Their job is to run the company and keep it going and maximize the price, right? So our job is to be behind the scenes, making sure that the whole process is running as smoothly as possible. We're interfacing with as many people as the owner wants us to, and we're providing that sense of assurance that the seller needs.
Yeah, I mean, if you think about it, so you got a business owner here. They want to maximize the value of the sale. They want to pay as little money as possible to their advisors and service providers. And if they don't know their own finances, they don't know their own financial statements, and they can't answer these questions, then the value comes down. So understandably, having the right CPA relationship and having the CPA relationship that's been in existence for a while will maximize the value that a business owner gets, right?
Right.
So this is one reason why when I take on a new business owner client, one of the first questions I ask them is not only who's your CPA, but how long have you been with them?
Right.
And I'm very reluctant to take on a new client that does not have a CPA relationship. It scares the daylights out of me because what else is there that I don't know?
Right.
Right. So when you're giving these assurances, now the deal goes faster, more assurances. They're not going to come back and nickel and dime you. So Jack, you've talked about these representations that we're making. How much of the work that Alex and his firm and CPA firms that provide, how much of that do you rely on when you're drafting your agreements on the sell side?
Well, I mean, the buyer ultimately cares greatly about the financials and the condition of the financials, and those sometimes kill deals if they once they can dig into the financials, they realize that it's not all what it's cracked up to be. And one of the things that Alex brought up was the busted S election. I mean, this comes up all the time, and eventually, they're easy to bust.
They are, yeah.
I mean, and so a buyer comes across the busted S election. You give the other side's accountants and tax attorneys all sorts of work to start mining through what the implications could be, and those implications ultimately usually end up being the buyer asking for a bigger holdback of purchase price proceeds, and they're going to hold it longer until they can get this issue resolved. And these will be discovered when you've already spent a lot of money on your attorneys to get you ready for a sale. So now you're heavily invested in a deal where you've given all of a sudden a lot of leverage has transitioned to a buyer, and they're going to use that busted S election issue to really make things miserable for you.
Well, let's talk about busting an S elections because I think some folks may be unclear about that. What are we talking about when we say you've busted the S election?
There's several criteria for having an S corporation. You can only have one class of stock. I mean, Jack, you'll have to help me if I forget a few, but you can only have 100 shareholders. There are going to be certain types of shareholders.
Domestic.
Yeah, domestic. Yeah. Are there any others you can think of?
Yeah,
those are the main ones I think of.
And so what we're talking about busting the S election is the business owner has done something inadvertently.
Right.
Usually inadvertently.
Usually.
And then the CPA discovers later.
Right.
Or this gets discovered, worst case scenario, it gets discovered in the middle
during the deal.
During the M&A transaction. Yeah. And it's a nightmare.
Right.
It's a nightmare because guess what? It's not just the buyer that cares about this, but their silent business partner, the IRS, cares about this. And so when you're talking about holdbacks, is you might still get the deal done, but all of a sudden the buyer's like, we're going to hold back some of this money because we think the IRS is going to come ask for this money, or we're voluntarily going to go to the IRS and say, hey, we want to correct this. So now you end up with less money. Interesting, isn't it? Business owner spends all this time trying to grow the company, but if you follow that 80,000 page manual that the IRS gives you, you could probably end up saving a lot of money. And that's where the advice part comes in, right? And so talking about busting that S election. So they've busted the S election. We got a problem here, but it's not all doom and gloom, right? There's a process for handling this. So talk to me a little bit about your experience when something like this happens.
Yeah, what
that looks like.
Right. Usually, what happens is that we're going to look back at a prior year returns, and we're going to make sure that they qualify. There is a late election relief you can get if you've followed certain criteria, if you've filed as if you're an S corporation and things like that. But during that time that the S election has been busted, you're supposed to be taxed as a corporation. And so you filed the wrong return is ultimately what it comes down to. This late election relief that I mentioned, we've had good luck with that. There are tax implications you have to deal with not having an S corporation, but you can get the IRS to waive some of those penalties sometimes if you fit this revenue procedure qualifications. Yeah. And so we've had good luck with that. The IRS over the last couple of years has been fairly understanding when this comes up. You provide assurance to the IRS that it was inadvertent, and that you filed as if it was an S corporation, you paid tax as if it was an S corporation, and there are several other criteria, but that's the main thing we've come across. Yeah. But sometimes with larger companies, that can be a huge liability issue. Yeah. Have you had any of those, Jack?
Yeah, I mean, so that's what we're usually telling to the buyer is like, look, we've always looked like it, we always smelled like it. The IRS is not going to make a big deal about this. And we have our accountants here who are telling us this. We have experienced tax attorneys telling us this, and the other side knows that too. But the issue is now we have an issue to argue about that they can hold against us. And if the seller was doing what they were supposed to be doing and had good advice and constantly going to their CPA to talk to them, this issue doesn't come up. So then we're not spending hourly rates or fees trying to figure it out, trying to put together a solution for it, and things would go a lot smoother.
Yeah, and you've given up leverage now. Now there's one more point to negotiate to horse trade on this. So speaking of holdbacks, talk about a situation where you have business partners where one person is leaving, the other one is staying, and they're leaving in the middle of the year, right? And now we have to make a decision on when we're closing the tax year.
Right.
There's K1s, and once you leave, your partner may run the business in a certain way that might be more advantageous to them versus you, sticking you with the tax liability while they take the deductions the rest of the year.
Right.
So if you have a business owner who's in a partnership and they're leaving, how important is it to not just rely on the corporate CPA, but to also hire their own CPA now that they're about to leave, because there's issues like this that come up and they need really good representation, because otherwise they could get stuck with, they got the sale price that they wanted. Oh, by the way, here's a surprise tax bill.
Yes.
And now you're not going to end up with as much as you are. So what does that look like?
Yeah. Well, a lot of that is hopefully the CPA, the corporate CPA, is recognizing that he could potentially have a conflict of interest. And so he shouldn't be representing both sides, because when he does something to maximize one side, he's adversarial to the other side. So he should be recommending that there's another CPA brought in, or maybe counsel as well, depending on the situation. And so we've had that several times where it makes sense to bring someone from the outside in to the transaction, another CPA or another enrolled agent, someone who can represent on a contractual basis for the other partner, to make sure everybody's getting a fair shake, right? Because that's the ultimate goal, is that everybody hopefully wants everybody else to have a fair shake of the deal. But usually what that involves is that, you have to decide when are the books going to be closed for the year. Because when you're in a partnership, as of the date of sale, you're going to close the books and you're going to allocate the income to the partners as of that date. And then the rest of the year will be allocated to whoever remaining the partner is. So it's extremely important, right? Because they could have a horrible beginning of the year
Right.
And then everyone's allocated losses, and then the rest of the year is great. And if you didn't agree how that was done, then your K1 could potentially be extremely different than the actual result was. And that's a discussion that we have with the outside accountant, with attorneys if necessary, and so, and bringing the business owners in, obviously, they're the most important part of it. So educating them so that they understand what's going on, what we're arguing about.
Yeah.
Right.
Yeah. It's so interesting that, the first thing that a business owner looks at is, okay, how much am I going to get paid for this transaction? But the real important question to ask is, all right, I sold this business. How much is ending up in my pocket net of taxes? And it's not just the capital gains tax,
right?
Not just, recapture.
Yes, exactly.
Holdbacks, everything else that comes with it. So really, it becomes so important to have a good team of advisors that could actually model this out for you and tell you to the penny. I mean, maybe not to the penny, but pretty darn close.
Pretty close, yeah.
Where, this is what we're looking at here, the liabilities. And Jack, talking about partnerships where you're closing the business middle of the year, we're talking about holdbacks and contingencies. Obviously, that's something right up your alley where, if you have certainty, now you're not so worried about putting some language in the document, but in a situation where the taxes are unknown, how big of a deal is that in the negotiation?
Well, it's one of those things where when it comes up after the LOI and in the middle of due diligence, it's a little too late. I mean, you've already kind of once a client I found starts putting in money towards the transaction, they get more and more invested in it being closed, and so what ends up happening is, okay, a buyer might come along and say, in the middle of due diligence process, hey, we've looked at your financials. We looked at the tax consequences from our side. We want to go through a tax restructuring. So this folds into our company better. Well, that could have tax consequences to the seller, significant ones that they weren't expecting. And if they don't even know kind of what they were expecting coming out of it, they're in the middle of this thing. They're thinking, oh, I'm, selling this for millions of dollars. And in reality, and, they have ideas of what they wanted to do with those millions of dollars after they sold. Yeah. And then a year goes by, they pay off the debt. Most transactions, you pay off all the debt you have. And then they have to pay the IRS. You have to pay Uncle Sam. And all of a sudden, it's a lot less. And they realize maybe they like being a business owner and getting the income that they had. And they really should have had a different approach than, oh, I'm just going to sell this and walk away.
Yeah, I want to go back to this topic of partnerships where one person's exiting. So oftentimes for future tax considerations, one of the partners wants to structure the purchase a certain way. So for example, maybe do an entity purchase or however they want to structure it because they're doing basis management. Yeah. Right. And so it becomes really important that when you're having this one person exiting, everybody gets their own representation to protect their own interest. Right. And because there's some pitfalls there. What are you seeing as far as when partnerships are dissolving? Well, I don't want to say dissolving, but when one person's buying out the other partner or there's an exit of some sort, what do you see as the steps that a partner who's about to leave, what's the best practice that they could engage in? And when does that start to seek out counsel, not just for the purchase price, but for things that might impact them later on, the trade-offs that we've been talking about.
Right. So that's a discussion to have over time. That should be a discussion that should happen, I would say, at least a year in advance of if you're looking to leave. You need to be looking long-term and making sure that you're comfortable with how the entity's operating, because even when you separate, there are potential liabilities that could come back to you if they were incurred before you left. And so that's something that the partner has to be aware of and comfortable with. And yeah, they need to be engaging someone alongside them to be looking at the situation as well so that they can make an informed decision. And sometimes if that happens, the other partners don't like it. And so you have to be okay with that And that's something to keep in mind if you're looking to separate from your partnership. It can be an uncomfortable conversation sometimes.
Yeah. So Jack and I have had this discussion with other attorneys in here where we talk about, how do you seek counsel without getting your partners to lawyer up and turn this once amicable relationship into a hostile relationship, if for no other reason than the other person says, well, wait, you're lawyering up, I got to lawyer up.
Yeah, right.
But this is really important, right? So communication becomes really key when partners sit down and talk about, hey, look, at some point, our interests diverge, and that's perfectly fine. Let's find an amicable way. But, my interests may be different than Jack's interests, right? So in that situation then, Jack, you've worked on partners separating. They just got to be honest with each other, right? At some point, you got to say, "Hey, we're going to go our different ways. What's the best way to approach this? You get an attorney, I get an attorney, or I get an advisor, you get an advisor." And for the most part, I don't know, Alex, if you see this too, but a lot of middle market companies, lower middle market companies, they've started off as a mom and pop. They've grown, they've done really nice things, but they're still operating like a mom and pop at some point. So maybe corporate governance isn't there. Maybe there's no buy-sell agreement involved, right? So, if we're advising our clients or group of clients, what we're telling them is, hey, you're going to come across this situation at some point. You really want to have open communication so that there's no surprises, because you don't want to go from this amicable situation to going to an adverse situation all of a sudden, because guess what? Fees go up because, we talked about this with Lincoln the other day about the perils and costs of litigation. If emotions get the best of people, right? And now it becomes, I want to take your head off. I want to take your head off. Spirals out of control really fast. So what would we tell somebody who's in this situation? What would we tell them, Jack?
Well, I mean, we're a tool for them to find a successful path forward. So, coming and engaging us and hiring us isn't necessarily us, putting on the fancy suit and inserting ourselves in the conversation actively. Sometimes it's you're coming to us to explain to you certain consequences or give you certain ideas of how to handle a situation. And we're just maybe in the background telling you, hey, these are certain outcomes that we see in these types of situations. This is what could happen. And we're just giving you knowledge and information to go to your partner now and say, okay, this is what I'm thinking, and this is how I want to handle it, without having to feel like you got to bring in, the muscle to get it done.
And that's a really good point, because a lot of times people associate lawyering up or hiring advisors with, go talk to my advisors. That's not necessarily what we want them to do, right? We are in the background oftentimes, especially initially, advising them, helping them gain knowledge so that they could navigate to ultimately what they want, and only bring us in when it's absolutely necessary or when it's time for us to come in, because we don't want that adversarial relationship. Because as you guys know, at the end of the day, the more efficient the process is, the more money the clients keep in their pocket.
And, we don't want to break down trust. When trust breaks down, that's when things start to get really messy. And so when you insert your experts or your advisors and you put someone on the defensive, all of a sudden the trust starts to break down between you, when really a lot of times clients come to us and they just want to be fair to their partners, but they want to make sure they're in a situation that's a good outcome for them. So they're trying to find a fair and moral ground. But boy, if you start to be aggressive or take certain steps that start to break down trust, then all of a sudden this idea of I was going to be fair and moral seems to go out the window. And now all of a sudden you guys are adversaries, where for maybe even years, you guys had got along perfectly and saw eye to eye on everything.
Let alone the fact that when trust breaks down between partners, then the business itself is hurt, the ongoing business, right? And then the business itself that you're trying to buy out of or buy into is affected as well. And that, talking about being in the background is a great point, because I would say, as far as the CPA goes, if you've got a corporate CPA that's preparing the partnership return, the partner can ask for a copy of the partnership return and provide it to an outside CPA and just say, hey, can you take a look at this? Is there anything you can see that I should think about, or any questions I should ask? I think that's a great idea. And then the other partner's not even aware of it, unless our client has never asked any questions like that before, then they might be a little suspicious, but that's less threatening, right? Like we talked about, we're in the background, we're providing assistance, we're providing advice, and we're just looking, we're just making sure everybody's doing what they're supposed to.
Yeah. And obviously in a partnership like that, where it's flowing through, understand that the consequences go both ways.
Right.
Exactly. So the decision that you make is going to impact both of you equally way. So there's all the incentive in the world to work together. You mentioned asking for copies of the corporate returns.
Right.
A lot of times partners in a business will just take the K1s and they'll just go to their CPA, or oftentimes they might use the corporate CPA who's doing individual tax returns as well.
Right.
So really important to get into the habit of getting copies of those so you could look at it as well, so you don't find yourself in a situation one day you ask them a question and now suspicions go off. Speaking of which, with individual tax filers, we know if there's one partner in a married filing jointly where they were innocent, there's relief that the IRS provides. Is there such a thing with business partnerships where a partner who receives a K1, but they're a partner and they should have been looking at something, they don't, and we talk about how ultimately the IRS says the taxpayer is ultimately responsible, even if they had a professional help them with the taxes. Is there such relief, or is there any remedies to business partners?
That's a good question. I haven't come across that. Jack, have you?
I don't think so either.
Okay, so
I believe you're responsible. Yeah.
So signer beware. So good idea for business owners to not just take the K1s, but also take the actual tax returns, but more so the financials, right? Have their CPA look at the financials, not just the tax returns, because tax accounting different than financial accounting.
Can be very different. Yeah, exactly.
Right. And so having access to, making sure you're on top of it and you understand it also is going to give you better position for negotiation later on when you go sell that. What other things should a business owner consider when it comes to the advice that they need to get from a CPA? Maybe they're not getting right now.
Yeah.
Right. They're looking at a CPA and saying, okay, you do my tax returns, but what are they missing by not asking?
Yeah.
Or not what advisory work they should be doing now? Because like you said, at some point, every business voluntarily or involuntarily comes to an end.
Right.
And to put the business owner in the best position to maximize how much money they keep post-exit, there are things that they could do right now. And it starts with preparing.
Yeah.
And so what are some of those things that they should be doing from now?
I think number one is connecting all of your advisors, because if the three of us were working on a transaction, I know Jack, I can talk to him if I have any questions, or if I have an idea, I can say, hey, Jack, is this a liability issue? If this is something we're going to look at, or, if you have an idea, for a new wealth management strategy, and you can ask me, if there's any tax implications or anything like that. And that's all stuff that can go on in the background. And that's maximizing your advisors. That's maximizing your fees, I think, that you're paying your outside advisors. And I think connecting them, making sure they know each other, is going to really help clients. As far as other services, I would say definitely sit down with your CPA on an ongoing basis, whether you want to do it quarterly or year end or whatever, and just go through the tax return. Tell them what's going on, what you foresee in the next year. And then that can start a conversation of tax planning for that year. I have a client that got bought out of his S Corp by an Esop, and we've talked at year end before, it's looking like they might accelerate this Esop payment for this year, so we might need to do this strategy. We need to bring in the wealth advisor because we're going to have extra money coming in. And that started a whole conversation. And then it's not a surprise when we get to April. Or it's not a surprise when we do an ES payment calculation and we tell them, you owe hundreds of thousands of dollars. And that's really important, because the more involved your CPA and your advisors are, the less surprises are going to come up, the less issues you're going to run into, right? Because then they can provide their advice for how to handle these upcoming situations.
Yeah. So Esops, I'm going to have you back to talk about Esops. That's a very interesting topic. A lot of folks don't understand that when you do an Esop, your employees aren't necessarily paying you the money, right? The bank's paying the money.
Right.
But that's a very interesting way of exiting a business for folks who don't have an outside buyer.
Right.
Exactly. So we'll talk about that sometime. So Alex, thanks for coming on.
Absolutely. It was a pleasure. Thank you.
All right.
Information contained in this podcast and accompanying video have been derived from sources believed to be reliable. This content is not guaranteed as to its accuracy and does not purport to be a complete analysis of the topics discussed. Analysis is based on assumptions that may not come to pass. None of the content should be construed as legal or investment advice. You should consult with a qualified professional before implementing any strategies discussed. All expressions of opinion reflect the judgment of the speakers on the date the video was recorded and are subject to change.